Okay, well, good day to all my panelists and to people joining us from around the world. Welcome to our little podcast, if you can call it that. We're going to be talking today about M&A. Okay, for those of you out there who do not know what that means, I'll just give you a quick rundown. It means mergers and acquisitions. Okay, and we've got a set of very professional people here that are going to help me elaborate. I'm just here moderating and make sure that people stay in line and don't get too crazy. Okay, so without further ado, I'm going to introduce everyone. First and foremost, we're going to introduce the man who put this all together, or the company that put it all together, Mr. Jerome Vogel. He is the co-founder and partner with Vogel and Potamianus LLP, and he is known as the Dealmaker and innovator in the legal community. I actually gave him that title. So he successfully represents sellers and buyers in stock purchases, asset purchases, and buyouts. He was selected to be the Super Lawyers Rising Stars for 2020 and 2021. Fun fact about Jerome, people, is that if you ever play golf with him, it is impossible to pay for lunch post-game. Just cannot do it. And the other great thing about Jerome is if you ever use his services or become a member of F&P, they send you the most amazing coffee, people, from all over the world. That's like the one thing I'm excited about during this pandemic, is to wake up and see that, you know, I've got a delivery from F&P and some stuff from my home country of Zimbabwe came in. It's amazing. So remember that if you join in F&P. Coffee's amazing. And then we have the master, Mr. Constantine Potamianus, co-founder and partner with Vogel and Potamianus, advises private and publicly held companies on strategic, corporate, and operations matters, as well as serves as a mentor at a number of business accelerators, including Techstars, Bunker Labs, and Patriot Bootcamp. Fun fact about Constantine: he served in the US Army, okay, as a systems analyst in the private sector, and as an administration officer in the federal government, and as the co-founder for an information system consulting company and a radio frequency engineering services company. So that is a book, that is the cover, there's lots inside there, okay? So stay tuned whenever Constantine speaks, pay attention. Okay, now to our outside panelists. The master, Mr. Channing Hamlet, is the managing director at Objective Capital Partners. They are focused primarily on leading transaction execution for the investment banking practice and leading the business valuation practice. Mr. Hamlet is a results-driven executive that has over 25 years of experience advising business owners on transaction execution, management issues, and business valuations. Most recently, he was chosen as an investment banking visionary 2021 by the Los Angeles Times, and as a leader of influence investment bankers 2020 by the Los Angeles Business Journal. Fun facts for Channing: he holds a FINRA Series 7, okay? Ask me if that is after that, okay? After this thing, yes, it poses a question. He has 63 and 79 licenses and a registered representative of the BA Securities LLC, and a member of FINRA SIPC. Last and certainly not least, okay, the infamous Heather Madland. She is a partner at Huron Capital. She has over 20 years experience originating, structuring, and executing debt and equity transactions in the middle market. Prior to joining Huron Capital, Heather was responsible for all West Coast new business development at SPP Capital Partners, a New York-based investment bank. Heather also served as vice president and team leader of middle market banking at Camara Bank in San Francisco, and also held roles at CIT, Sponsor Finance, and Madison Capital Funding, LLC, where she focused on originating and structuring leverage finance products for private equity clients. Fun fact for Heather.
Okay.
She lives by the term of hard work, commitment, perseverance, and discipline. Heather is, people, a wine enthusiast and a self-proclaimed foodie. So we were just discussing this prior. You can do all the deals you want, all the M&A you want, but you need food and drink to sustainize your body and make you super, super intelligent and make you get that big deal. So don't forget that. Okay, so panelists, welcome. Thank you all for coming in today and being with us. We're going to do more of a sort of an open table here. I'm going to bring up a couple of points and then feel free just to jump in. We're going to start, I think, right at the top of the gate, which is the current state of M&A. And I want to read something that a gentleman by the name of Brian Levy wrote. He's a global deals industry leader. He's a partner there, and he wrote on the current state of M&A. COVID-19 has given companies a rare glimpse into their future, and many did not like what they saw. An acceleration of digitalization and transformation of their businesses instantly became a top priority, with M&A the fastest way to make that happen, creating a highly competitive landscape for the right deals. Panelists, do you concur? And if you don't, what is your view on the current state of M&A? Heather, you look eager. Let's hear what you're going to say.
Well, Channing, I'm interested in particularly what you're going to say as well, but I would say, digitization, technology enablement aside, which I think is a secular trend that's here to stay and drive, accelerate growth in private companies, for a long time. And we all play on that trend in the deals that we do. We're in like an unprecedented market environment for M&A activity. Our deal flow is up nearly 50% over prior year. Yes, the second quarter of last year was not a great comp, but based on conversations with folks like Channing, folks are having record months of pitch activity leading up to what I think is going to be an unprecedented amount of deal volume in July and August. Historically, we would see a pickup in activity post Labor Day. What we're hearing and what I'm already seeing is a lead up in activity that's supposed to hit just after the 4th of July. So we're about 8 days out from that. I'm going to go in a deal bunker and never come out for about 3 months. But
I thought you were in there already, Heather. Is that not your deal bunker?
And I'm here already, right? It's been a crazy year on the heels of a really crazy back half of last year. But people, you need to pick your spots, and we can certainly talk about that as well. Channing, I want to hear what you have to say.
Yeah, no, I agree with the comment, Heather, you made around the secular trends around digitization, technology, et cetera. And I do think COVID at some level accelerated that. What was interesting is, last year in 2020, many investment banks, most of the investment bankers I know had their best year ever, which is really bizarre because the deal activity basically shut off in Q2 last year as a result of COVID. But Q4 last year was the highest number of M&A deals in a quarter in the past 10 years, if not ever. It was a record quarter by any metric. And I think that was driven by a number of things. It was driven by the presidential election and fears about tax policy change. It was driven by companies that benefited from COVID in terms of trying to sell based on really good and strong results. I think it was also in part driven by the very low cost and high availability of capital. So there's a lot of capital out there chasing deals. And so the Q4 last year was this unbelievable quarter. Multiples were high, the largest number of deals ever, just absolutely amazing. And then January this year seemed like it was going to start off slow. It seemed like a lot of deal activity got pulled forward, but 2 or 3 weeks into January, it was like, well, maybe it's another year of the same. And I think the Biden administration talking about, tax policy changes again, really pushed a lot of business owners to think about selling this year. And then again, the availability of capital and valuations are very high relative to historic norms, has caused kind of unprecedented levels of deal activity. And if you call an accounting firm and ask to have help with a quality of earnings review, or it's 6 to 8 weeks. I mean, people are scheduling out into September. Attorneys aren't calling people back. I mean, it's
a market study refresh is 6 figures and 8 weeks out.
It's crazy. It's crazy.
Study.
Everybody's really busy. And so one of the things I think we're seeing, one of the things that we're starting to see is we've sort of hit the time of year, it's roughly June 30th, 6-month sale process would be a fast process. And so we've hit the time of year where completing a transaction by the end of the year is unlikely for anybody starting now, particularly given how busy the buyers are and how busy all the professionals around the environment are. And so I think we may see a slowdown in new pitch activity in the second half of the year while people wait and see what happens with tax policy. However, the deals that are in market, I believe, are going to be aggressively worked on to get closed this year. And so everybody's really busy. The final trend that I've seen, and this has also been kind of a long-term trend, 25 years ago when I started in M&A, private equity was a little bit more of a cottage industry. There were a lot of smaller firms. You would meet a partner at a firm. That partner was in charge of, chef, cook, and bottle washer, basically. They were in charge of sourcing deals. They were in charge of doing deals, managing the portfolio company, and kind of like a jack of all trades. And the firms were modeling, very high returns, 35 to 40% annual returns. And when you model that out in an LBO model, you can afford to pay kind of 4.5 to 5 times EBITDA for a company. And fast forward 25 years later, the private equity firms have all, really focused on specializing. They've attracted a lot more capital. They're all now run like businesses where they have separate departments for origination, deal execution, portfolio management. They're bringing resources into their companies. They're starting to specialize in different industries and really sort of pick their niche and focus on it. And we've seen sort of an institutionalization of that industry over the past 25 years. And that I think that's a key driver of valuations kind of creeping up over the past 25 years, where companies that used to sell for maybe 5 to 7 times EBITDA are now selling for 8 to 10 times or more in this market. Whether that's here to stay or not, I don't know, but I think a lot of the specialization in private equity and the availability of capital and the amount of capital that's come into private equity is really driving the market that most of us play in, the lower middle market. So it's a very robust market right now.
Jerome, Constantine, what Channing was saying about the deal flow and taking 6 months, are you finding that from a legal perspective that it is taking, just with the amount of work, is that what's actually happening on the legal front during an acquisition or a merger?
Yeah, easily. We're just as busy as we've ever been, and like Channing and Heather, we've worked through a number of cycles over the last 25 years, and this is a very heated market. To Channing's point, I think part of that is driven by capital, needing to put that powder to work. You can only sit on so much dry powder before your LPs start wondering what's going on. So these private equity firms need to chase deals. Yeah. And of course, when demand exceeds supply, the price of the deals go up. So we're seeing some of these multiples and valuations perhaps be higher than they would in other circumstances. To Channing's point as well, the professional M&A markets, in other words, the private equity firms out there, have expanded in scope and number over the course of the last couple of decades. And there's a pipeline there where private equity company at a certain level will pick up a company at a certain level, they'll work on it, they'll fine tune it, they'll optimize it, and then they'll flip it to the next level in the private equity chain. And this will go on. And, that is it's a more viable also development and exit strategy for companies in the middle market.
Yeah.
At least that's what I've seen, in my experience so far.
Konstantin, do you think, talking about like what you've just proclaimed, like on the, the M&A or buying something, fixing it up and selling it, is the M&A market mirroring, I don't even know how to say that word, but it's mirror with ing on the end, mirroring the real estate market? I mean, that just seems the real estate market, where does that level end? And it seems to be just keep going up and up and in all these different places. And then they look at the same Q factors, don't they? In essence of, the money, cheap borrowing cash. I've got to say, I'm fascinated by these things. I'm from Zimbabwe. And, once upon a time, we had 500 million% inflation.
Yeah.
I don't know if my American watches can actually stomach that or actually swallow that, but 500 million% inflation. So we had a whole different things. M&A was never on anyone's lips in Africa because that just didn't happen. It was either something was forcibly taken or there was no talk of the way things are done. But yeah, is there a correlation between the real estate market and M&A in essence?
Okay, so first of all, let me thank you for declaring my utterances as proclamations. It gives me weight that they would not otherwise have. So.
Anything that comes out of your mouth, proclamation.
But secondly, I think it's an interesting phenomenon that you're talking about, which is, are we seeing similarities across asset classes?
Yes.
And yeah, there are certain similarities here. I mean, obviously, two kind of completely different things.
Yes.
Buying a business, buying real estate, but at the same time, maybe not. You're banking on cash flow typically, right? Especially if you're buying from a commercial standpoint for commercial real estate. And it is a supply issue as well. People are moving, people are worried about being able to buy, people are feeling pressured, to make a quick decision and are likely to overpay. I guess the question for us is, okay, if we believe the market is somewhat overheated, and if these valuations are higher than normal, are we at risk of having a bubble where, once the easy money gets eased back, once some of this dry powder is used, are we potentially going to see a depression of valuations? And that's an interesting question opposed to Heather and Channing in terms of, kind of the cyclical nature of these things and kind of what they see on the horizon.
Yeah, do you see that working in cyclical motion, Heather? Like just the MMA, have you and Channing, in all your experience that you had, is it something that you could sort of identify as cyclical?
Deal flow, M&A activity, I think a lot depends on where you specialize.
Yes.
And so firms who specialize in industrial businesses or oil and gas or something that tends to have more cyclicality in the demand cycle, sure, they're kind of playing the market. They know the ins and outs of it. They can quote unquote time it right. But I think, for us anyway, we follow secular trends more than we follow, I guess, specific industries that tend to cycle more.
Okay.
So, I would argue that even in a lull in M&A activity or some other kind of secular headwind or something that you may experience in the midst of your investment cycle, one of the ways that we help sort of counteract that, and I think it's something that's happening right now, is add-on activity. I mean, lots of business owners are out there, they understand private equity, and they're selling to private equity-backed strategics.
Yeah.
I mean, last year we bought 24 add-ons across 8 different portfolio companies. Wow. And given how high priced the multiples are, folks are coming in and buying platforms at 12 to 15 times. And the way they're averaging down that entry multiple is by buying add-ons that are much smaller, but way more strategic, getting them into new geographies, new services, new products for much less. And that's how they're averaging down their entry multiples. So it seems to be a strategy right now in this, quite competitive M&A environment to do that. And we're a buy and build shop. So we're going to play that game all day long, but that certainly helps in cyclical environments or headwinds that you don't anticipate, certainly.
Is the M&A deal flow, is that being accelerated by digitalization? Because if you go back 30 years and people were doing mergers and acquisitions, you'd have to call the company, fly from one country to the next. Is the ease of doing it, even though things are backed up because of but it just seems like even during COVID, like now, the activity, if you look at the numbers, like even the first half of this year is more than there was last year. Really?
Sure. I would probably position it more from a efficiency perspective, like flow of information, access to information is all more efficient because of digitization and technology. Yeah. And as a result, there are people out there who market companies online through online databases. And so your access to the market, if you're a business owner, you're getting called at least twice a week by whether it's a Channing or someone else about if you're interested in selling. I mean, people are using technology tools to get access to business owners that are way more compelling and effective than 10 or 15, even 5 years ago. Yeah. And so I would kind of position it from that perspective, in that it's easier to sell your business today because people know about you.
We're still, one of the things that Heather mentioned is, I think a lot of the tools that are now in place are making access to information, the flow of information, the pace of play, a little bit quicker. And like if I go back to when I started doing investment banking, we were faxing and Federal Expressing things. There was no, there was no
computer, talking.
There was no text me to give me a quick update type situation. Yeah. But the process we follow is largely unchanged. So we're still like, most of our clients, when they sell their company, are very concerned about protecting confidentiality. Yes. They don't want their employees to find out they're for sale. They don't want their customers. They don't want their information to get in the wrong hands. And so in the middle market, I think we're still seeing people follow this very old standard, tailored, custom, labor intensive, discrete process. Heather mentioned something interesting. We've seen people start using some of these exchanges or, deal exchange online environments. Our firm's been experimenting with some of that stuff, but we've had really limited success with those types of things. It's really the old fashioned way is still what's been driving success for our clients. So I think there's probably a lot of room for improvement in the efficiency of the M&A process. Okay. But the obstacles are that it's often a very large, it's often a very large transaction for our clients who are, primarily closely held businesses where they're first time sellers. It's the largest transaction they'll work on in their lives, and they're sort of willing to spend the time and effort and money to have it be a, labor intensive, tailored process, not something that's automated. And it's going to be interesting to see how that changes over the next, 5, 10, 15 years. I think that's a fascinating thing that Heather pointed out. And then back to your original question, I think in terms of valuations,
Yes.
and cyclicality,
Yes.
we're I have the same like cracked and broken crystal ball that everybody else on the panel and in the audience has.
Yeah.
But we are, I think we are in the longest period of economic expansion.
Yes.
If you take, if you normalize for COVID, we're in the longest period of economic expansion by a long shot that the country's ever been in modern recorded economic history.
Yeah.
And so, at some level, we're all fooling ourselves if we think this is the new normal and it's always going to be up and to the right. At another level, there are a lot of sort of, macro trends and secular trends that are all still very, still very positive. And so I think from everything I'm hearing and, what we're seeing at our firm, we're really optimistic about the next couple of years.
So just to go back quickly, so and on what you just said, Channing. So I'm gonna just say something else. So the valuation, like let's say someone's selling their company, right? And Heather's talking about 12, 15 times EBITDA. The valuation of a company's assets today remains, well, this is hearsay, but remains apparently one of the biggest challenges to merger and acquisition success. So the way that the assets are valued. Then comes the other thing I want to talk about, which is then bridging the valuation with the financial gaps. Is there something happening in that regard? Like because of these huge EBITDAs, these huge multiples, is the valuation, is that remaining difficult? And also in a time of COVID where you're looking 5 years down the road and people thinking, wait, if we have a COVID 2.0, what's going to happen to my office building downtown? How is that valuation? Surely that must be is very difficult now in the M&A world, is to correctly value something and then bridge that with the actual financing. Are you seeing that, or is that something that's happening with, or looking? Channing, sorry, just
yeah. So
down the line.
Yeah, there's a couple questions embedded there. One is COVID. There definitely have been winners and losers in COVID, and we've seen companies that did 4 million in EBITDA in 2019, and then 25 million in EBITDA in 2025.
Wow.
And 20 of the increase relates to products that are kind of driven by COVID.
Yes.
And so that's a difficult business to sell. That's a difficult business to do a transaction, because the seller's sitting there saying, hey, I made $25 million last year.
Yeah.
And the buyer's sitting there saying, well, you're probably going right back to 4. You're probably going right back to 4. And so in a lot of industries and sectors, I think a lot of people are just kind of sitting on the sidelines waiting to see how things normalize for COVID, or buyers are being, very, very conservative. And then the flip side is true also, where, there are a number of businesses that were impacted by COVID that you would expect to bounce back. And the seller is making the argument, hey, like COVID was an unusual thing, I'm going to bounce right back. Mr. and Mrs. Buyer, when you own my company, it's going to be just like it used to be. Yeah. And, buyers aren't necessarily buying into that. So it's a pretty tricky environment right now to get deals done as we're, knock on wood, hopefully rolling out of COVID. It's a pretty tricky environment to really sort of understand fundamentally what is the earnings capacity and the EBITDA of a company. And then there's the whole host of other questions about, has COVID fundamentally changed behavior? Are people truly going to stop going to retail shops? Are people going to stop going to the office? Are people going to do this? Are people going to do that?
Yeah.
Nobody knows, and that's creating a lot of uncertainty. So that it's an interesting time to be, working on, transactions during the COVID era, for sure.
And then, well, I mean, then you got professionals like Constantine and Jerome that make their clients feel confident and safe. So with that,
yeah.
Jerome, what do you feel about that? Like in terms of like what Channing just said about, people saying, well, how do you write that into a context in the agreement to make the buyer feel good and the seller feel good in essence?
Yeah, there's a couple things. First off, yeah, we're taking people's calls, even if we're busy. So
Right.
that's just good. That's just good. That's just good business and just being good people, treating people the way they want to be treated. I would just say two things. One is I think it's really important to look at kind of what Delaware is doing, and I think that they have really developed a body of law around these transactions. And Delaware typically is holding buyers to their deals. Okay. There was a recent case, Snow Phipps Group, LLC versus Cake Acquisition. And essentially, the buyer said, hey, we can't close because we can't get debt financing. Yes. And we can't close because, hey, the seller has, changed their business due to COVID. And basically the Delaware judge basically said this chalks up a victory for deal certainty, because we're gonna resolve all issues in favor of the seller, and they ordered the buyers to close. They basically just said, listen, the unavailability of your financing is not material to this deal. We're not going to let you out of it for whatever the reasons are. So I think Delaware is a really good place to look at in terms of deals closing, whether or not buyers are able to access the financing they thought they could. The other point I think is net working capital. I mean, I have a lot of discussions with bankers, with other attorneys about how this is being defined. There was a recent case, Deluxe Entertainment versus DLX Acquisition. Essentially, what happened was that the seller claimed, hey, we're entitled to the cash that's in our bank account that we didn't withdraw prior to the closing of the sale. Yeah. And the court said, listen, even though you said this is going to be a cash-free transaction, in the net working capital definition, you didn't say, hey, these assets are not transferred to buyer. Therefore, they just plainly read the agreement and said, no, that cash is the buyer's. So I think that one thing to advising clients to do is, hey, you have to read between the lines in these LOIs and make sure that in the agreements you have these things nailed down, and so you kind of circumvent any loopholes there. So I think that there's a couple of examples of little things that we can do to advise buyers or sellers in the context of M&A. As people are looking to get out of deals, people are looking to recoup maybe money they lost on deals or whatever it is, and I think there's a couple of ways you can do it.
Yeah, Mark.
Sorry, Constantine, go ahead.
Sorry, Heather. Jerome makes a good point, which is the devil is always in the details. And that's where, we focus our energy, is kind of taking care of as many of these potential contingencies as possible. There's no excuse for not saying what happens to cash in a deal. Come on. I mean, it's, and, from our perspective, we've always tried to nail down as much detail as we can at the LOI level, even if it's non-binding, et cetera, to just kind of set the tone for the rest of the transaction. Get as many details as we can down there. Of course, there's going to be stuff that doesn't work in there, but the more you get down there in terms of having theoretically achieved the meeting of the minds, the smoother and faster that deal can progress, at least from a documentation and negotiation standpoint. So that's something we always advise, our clients. And look, we've heard it both ways. Oh, let's just get an LOI done, to get the process rolling. Yes. It's like, okay, but if you leave a lot of stuff open, that fast process that you're trying to start is going to end up slower than you think.
Yeah.
We always tell our clients that the deal and the LOI is really only as strong as the foundation upon which it's built. And so, we spend a lot of time thinking about how much work the buyer actually did before the LOI gets signed. And if you can use the house, the realtor house analogy, that if the buyer of your house kind of came and did a 3-minute walkthrough, and made you an offer, when inspection time comes, you're going to have a lot of issues come up. Where if the buyer spent an hour at your house and asked you a bunch of questions and really looked at everything, when inspection time comes, the buyer already knows the house. They're not going to have as many issues. In a business sale, the same holds true. And so we tend to work really hard to make sure that buyers have all of the information, the good, the bad, and the ugly, so that when we do sign an LOI, it's built on a strong foundation, and there aren't changes. Like Heather and firms like hers get accused all the time of retrading deals. And you always hear about how the private equity firm came in and they signed a high LOI, and then they came in and like cut the price and changed this and changed that. Usually if you start asking like intelligent questions about what actually happened, the seller is like, well, I know they thought I had 10 million in EBITDA, but I really only had 7, but that shouldn't be a big deal. Or, I know I told them this, but that was actually true, So I think that one of the keys is like getting the seller to share a lot of information and getting the buyer to do a lot of work before an LOI is signed, so that it's real. Interested in Heather's perspective on that.
Heather, what's your response?
I was going to say, what's interesting about where we started this conversation, which is specialization and focus. I actually think, if a seller is being savvy or getting good guidance from the Channings of the world, then they're talking to potential buyers that really understand their industry, whether they're strategic acquirers or they're going to buy them as a platform. If you know HVAC services inside and out, the right questions to ask, you will be, that will help limit surprises when you get to the LOI stage. And I also think it will not only help with certainty of close, because you're dealing with someone who understands work in process and, project pipelines, and they understand the right questions to ask, so that, as you're moving through the process, you're not going to have as many surprises. It also helps with speed, because with all the advisors tied up with long wait times, a lot of these private equity buyers who know industries, they don't need to do a market study. They understand how the quality of earnings works. And if there's a sell side, maybe they're comfortable with certain parts of it and can rely on it because they understand the business model. And I think that is ultimately where specialization is going. It's helping with certainty, it's helping with speed, and it's helping with conviction. And that's certainly the evolution that we're making toward being more focused as a firm, to help us with all of those things. And I think it helps sellers at the end of the day as well. Channing, I'm sure you can tell the difference between a potential buyer that understands that business owner's industry or doesn't. They ask better questions.
I love the way Channing reverted it back to the real estate thing. We've merged that again. So which is true. You go and buy a property, you want to know if there's going to be, if the roots have grown through the pipes or whatever. You can, it's the as is clause. Buy the property as is, or if you're going to buy it, you got to go through it properly to know what you're getting yourself into, for sure.
And Mark, I'll just say one more thing about creative structuring to combat some of these valuations and the uncertainties and question marks around sustainability of earnings. Like people like, Jerome and Constantine, they're probably giving clients great advice about earnout structures or things that you can do to sort of bridge the gap between the COVID bump or the COVID decline. One of the things that we did that was really interesting during COVID, and even still today, is we put in something called a maintenance earnout. So it wasn't like, hey, you needed to, achieve above a certain EBITDA threshold. It was like, we get times are uncertain. If you could just maintain your EBITDA through the rest of the year, you'll get the remaining 20% of the, of the purchase price, or however you elect to structure it. I think there's been some real creativity that's come out of this market that I think some of it will be here to stay because it's applicable in a variety of situations, not just global pandemics.
And what's interesting is when the conversation we're having with our clients at the end of the day, when they get an offer that has an earnout or a contingent component, often the advice has been like, hey, don't count on the earnout, just, count on the cash at closing. And if the earnout, if you get it, you get it. And if you don't, you don't. But what's interesting in COVID times is you can, in the seller's shoes at some level, you can make the argument that you're still better off doing a deal with an earnout because if you don't hit the maintenance earnout, that means your EBITDA was down.
Mhm.
And then you go try to sell a year from now,
You would have got less.
you're going to wind up with less. And so you're actually still in a better place accepting this, earnout risk at some level than you would be holding the company. And, if a seller can get comfortable with that line of logic, it's a lot easier to have creative structures. If a seller can't get comfortable with that line of logic, the earnouts are, often very, very tricky and ill-advised.
So with that in mind, what are the current deal structures in terms of stock purchase, merger, asset acquisition? What is the current deal structure for right now for like an M&A? What's the current? What's going on in the market?
Attorneys answer that.
Yeah.
I mean, we're seeing across the board, but typically, we're seeing, I think 6 months ago, I think some of the companies that we thought were going to have an earnout, they were getting, 100% cash offers. Recently, I think we're definitely seeing, maybe 20% earnout, maybe 10% rolled into NewCo. So typically they'll have, the buyer will have another company that's set up that they'll want the seller to have equity in to kind of ride with the deal. And so we're, anywhere from 10 to sometimes up to 30%, but typically that's what we're seeing. There's been some crazy valuations. I know in some of the technology, healthcare, I'm hearing 10 to 20. I haven't been a part of those deals, but I've just heard some of those multiples are really wild. But in the space that we're playing, typically we're seeing, earnings based on 12-month trailing, and some kind of an earnout and some kind of a rollover equity into a NewCo is typically kind of what we're seeing. I don't know if Heather, Channing, that's consistent with what you guys are doing.
Mhm.
Yeah, I think that Heather's concept of maintenance earnout, where the buyer and seller are sort of sharing the risk of what happens with COVID and whether there's a second wave or a third wave. I'm hearing a lot of people using that type of a structure right now, just because we're in a people still want to get deals done, and that's a creative and clever way to sort of have buyer and seller share the risk.
Hey, if I may, let me throw something out, and I'm not looking to usurp Mark's position as moderator.
No, please, Constantine, be my guest. Throw it in there, man.
Always awesome. We're talking about how heated the market is, which it is, and I think it's amazing that we have that enthusiasm and dynamism in the market, particularly given what we've kind of collectively gone through over the course of the past year. But I want to take a moment and hit on Channing's point from earlier, which is that we're sitting on, one of the longest business expansions in history. So I want to pose a question to Heather and Channing, which is, okay, what's your nightmare scenario? What keeps you awake at night in terms of, what can shock the markets or work to degrade them, rather quickly, in your views?
I've worked through a couple kind of tricky and challenging economic cycles in the past, and it's usually been a shock to capital availability that causes a little bit of a correction, and then that causes sort of a confidence crisis, and then things kind of slow down. And if you look at what happened with COVID, that's exactly what happened. Is there was the government stepped in and sort of corrected the fear and lack of confidence with a big stimulus package, which I think has helped. So it's usually something comes up where there's a capital constraint that sort of gets the snowball rolling downhill. I told you about my crystal ball earlier. I have no idea what to be looking at or where it'll come from, but that's the fear.
It does seem that between fiscal and monetary policy, the federal government has assisted. I mean, I've been through a couple of cycles myself, and I still remember the '87 crash and the 2001 market changes, and of course everybody remembers the fun of 2008, 2009. So
unfortunately,
yeah, but we've managed to come back, and I think following each of those, you've seen the government's kind of emergency response get perhaps a little bit better over time. But anyway, how about you, Heather? What's your take on that? What keeps you up awake at night?
I think the public market, from a confidence perspective, is always kind of the first thing to sort of give people trepidation. I also think private equity as an asset class has moved into a more public market environment, i.e. BDCs for leveraged lending. Some private equity firms are public. We now have SPACs. So I think the public markets are playing a bigger role in the private markets as well. And I think, unfortunately, that is exactly what we saw in COVID. And we were hearing stories and I would say rumors from BDCs that were potentially close to shutting down because, they couldn't raise any additional capital. They couldn't fund lines of credit and calls for that for companies wanting additional liquidity. I think that, that hurt us in 2008-09, and it hurt us again during the pandemic. So public markets, certainly inflation could be a concern. It's been a concern for 20 years and still hasn't really reared its ugly head. But I do think just consumer spending overall amid and rising inflation is a concern, especially, given some of the end markets that we pursue. And then finally, I'll just say, look, this whole shift in how we do business and its impact on the commercial real estate market and urbanization trends, which I think lots of businesses were built on people living close together in cities. And if you think about, there is a trend out of cities at the moment. Will it turn back around? Though I heard New York City is a really fun place to be right now. That aside, I do think the way people work will have longer term impacts on commercial real estate, urbanization, facility services, anything that goes into the built environment may change. So that keeps us awake a little bit because we are deep into services and commercial and industrial services specifically. And so that is certainly something we're keeping our eye on and looking at as a trend.
And to your point, Heather, there are fundamental shifts occurring that will continue to impact urbanization and everything else. At a very basic level, increased access to broadband makes it easier for a significant segment of the population to not be centered in urban environments. Autonomous vehicles, if you take out the hassle out of a commute where you're in a vehicle, you can live further out in the suburbs and it's not the pain in the butt that it is, to take that 2-hour commute into New York City because you're sitting there doing whatever you're doing. And there's going to be other, technological shifts that are going to impact that as well.
Constantine, I've got a great technological shift actually for you and for everyone. So I don't know if you've heard what my good amigo South African friend's been up to, Elon Musk, but you know, he's thrown all these satellites into the lower Earth orbit,
Yes.
Starlink, and he's going to provide lightning speed internet to everyone on the planet for next to nothing. And that is, I think, me personally, I'm doing a development project right now in Tulum, Mexico, and it's really strange when you see Tulum. Cancun was accepting 45 million tourists a year. They never shut down during COVID. But what really has shifted in that environment is that people have flown from all over the world, from Asia, from Europe, from North America, South America, to go and live in Tulum. But before it was like, you know, this vacation rentals, overnights. But then people were like, no, I want space now. I want my little compound. So all the builders and everyone, that's what everyone wants now. They want their workout space, they want their office, they want their house, and they want it all there. Just in case something like this happens again and they're not stuck in a studio apartment with nowhere to go. I mean, that can drive you crazy. So
well, they want quality of life as well. I mean,
right.
Tulum is a great, pretty place to hang out.
It is,
right?
yeah. And but then partnered with the you know, like you said, the internet service, because most people, like when you go into these internet cafes, and there's a great one called the Digital Jungle in Tulum, and it's amazing. I mean, it's like a 5-star New York hotel where everyone's just working. That's all they're doing. They're just on the internet, you know, with this blazing fast internet. So it's just, I can see the shift happening. It's kind of interesting with Tulum that welcomes so many international people, that everyone's kind of on the same mindset that, yeah, I want to live here and work here, but I want more space, and I want that. And that is going to have a big effect on the industrialized commercial office space world. I'm not saying that that's not going to happen, but I think there's going to be a big readjustment and realigning of that, because people want better quality of life.
Yeah, commercial real estate is one of those sectors that, you know, I'm not actively involved in, but
Yes.
you can kind of see that there are some tectonic shifts happening there.
Yes.
You know, I would not necessarily want to be holding a big commercial real estate portfolio right now, but that's me. I mean, I say that kind of flip without being, you know, actively in depth in the industry.
But is that not going to get repurposed, Constantine, when you say it like that? I mean,
I think it has to.
Yeah, it has to. Yeah.
I think it has to. I mean, you know, look at some of the traditional shopping malls trying to get repurposed as fulfillment centers and other things.
Correct.
You know, with that said, you know, there's a philosophical shift that's occurring as well. I was having drinks the other week with an acquaintance of mine that's the Texas regional head of an international, you know, law firm, sits on the executive committee, and he's saying, well, you know, I can't wait till, you know, we pull staff back into the office and get things going. And I'm like, that ain't happening, man. I mean, you can say that, and you might be able to pull team members in for, you know, weekly meetings, et cetera. And it depends on what you're doing. But I don't think a lot of people want to go back to that as kind of their sole way of working.
Yeah.
And as that sort of sorts itself out, you know, there's going to be some back and forth in different industries and different businesses. And I don't know if Channing and Heather are seeing that in some of the clients that they're working with. You know, most of the folks that we've worked with have said, surprisingly, it's worked out pretty well, you know, for us. But there's, you know, there's a lot of shifts going on right now.
I don't know what Channing and I do from a transaction perspective. It's, I think, sure, the more senior folks that can have flex schedules, and I mean, that was happening pre-COVID, but yes. I do think we're losing. I mean, in the short term, sure, we're all highly productive individuals working at home, but over the long term,
Yeah.
I think you do lose collaboration,
Yeah.
training, those types of activities, especially with the junior staff. I think that sort of information exchange and communication is lost a little bit. And I do think it creates ineffectiveness over a long period of time for the culture of a really small firm like Huron that's only 25 people.
Yeah.
And so we are acknowledging that people need flex time, but at the same time saying, okay, it's time to like commit to being back 3 or 4 days a week.
Yeah.
So I think it's shifted a little bit, but I do think that, having people back at work has some benefits. Channing, I'm curious how you would answer that.
I mean, I look at our clients, and we've had some clients that are software companies that shut their office down and they're not going back.
Going back. Yeah.
They're virtual and that works. What I like in our business, and it was interesting. I had a discussion with a number of advisors last week, and everybody's making, many of us are now vaccinated. And so when there's a new client opportunity or something like that, everybody's making a real effort to go and meet the potential client and prospect in person, because they feel like, as an investment banker or an attorney, a CPA, whatever, if I don't go meet him in person, my competitor will. And that's where the relationship's going to get created, and that's where they're going to get hired. And so I think there's going to be tremendous pressure to be kind of back to the old way of doing business in terms of doing a lot of work in person, because that's really where relationships get created.
Yeah.
For our firm, and just in professional services in general, like our widget that our firm manufactures is either an email, a spreadsheet, or a PowerPoint. And you can manufacture that widget pretty much anywhere. But a lot gets lost without the collaboration and being in the office together. I know in the first 5 to 10 years of my career, I learned more from my peers sitting in a bullpen, asking somebody, "Hey, I've got this problem. Like, have you seen that before?"
Yeah.
And we have not figured out how to replicate that. And short term, I don't think it's having an impact, but long term, it will.
And I will just close this out by saying, on the flip side, back to digitization, digitization finally came to our industry. And I don't think Zoom is going away. In fact, I think it will be used in productive ways going forward. I was on the phone with a banker today who said, I've been in 6 pitches the last 2 weeks, and in every single pitch, there's someone on Zoom.
Yeah.
Because now we're using it as a tool to extend invitations to junior folks, or say, meet the rest of my team. And he said, we had people on Zoom and the client had people on Zoom. And so what's
interesting is we've always had discussions about, hey, is this sensitive communication? Is it an email? Is it a phone call? Or is it an in-person meeting? And now we just have a fourth choice, which is it a video?
Oh, I just say it's a meeting.
Yeah.
Might as well.
Yeah.
It's funny.
Did you guys, to cap that off, did any of you watch the movie Real Players One, Steven Spielberg, where the guys, everyone's living in a container and they're on a treadmill and their whole life is virtual. It's kind of crazy, but I think to attest to what both Channing and Heather said is that, yes, that interpersonal, relationship, that's where it's at. I mean, that's the magic. A lot of magic happens there.
Not going anywhere.
Products are created, brainstorming with people. It's different when you're in person. I mean, people know that. So I think the next big drive is going to be to try and emulate that virtually, but who knows if we'll ever get there.
Mark, there's two quick audience questions. I'm sorry, guys. There was two quick audience questions.
Go ahead.
Did you? Okay, so one was basically, good evening. Want to follow up on a point Channing made earlier regarding it being challenging getting M&A around this time. However, I noticed that a lot of major banks made quite a profit in the M&A. Are these earnings just a reflection of a few major deals being facilitated, or was he referring to there being a slowdown in M&A deals?
Oh, I guess that's for me to answer.
Yeah.
I think it's tricky right now to get deals done because COVID has had an impact, positive or negative, on on most companies. And so when buyers are evaluating the underlying earnings and valuation, it's a little bit hard to kind of fully get your arms around the numbers and the valuation. Same, you know, sellers thinking about selling as well. And so that's made it a little bit tricky. But then there are other factors that are really kind of pushing to accelerate deal flow. There's a lot of money chasing deals. And then there's discussion in Washington about taxes going up.
Yeah.
You know, in 2020, there was discussion in Washington about taxes going up in 2021. So that created the massive spike in deal flow in the second half of 2020. And now there's discussion of taxes going up next year or retroactively or tomorrow or who knows. And that's driving, you know, massive urgency to get deals done right now. And I think as we're putting COVID in the rearview mirror, you know, it's just going to get easier and easier to evaluate the new normal for companies. So I would anticipate deal flow will remain strong.
Okay, so that's like looking forward for the rest of 21 into 22. You think it's going to remain strong and become easier to get deals, you know, through that?
Yeah,
through
I think as the goofy trends from COVID go in the rearview mirror,
yeah,
it'll become easier.
Is that from you, Channing, or is that from your crystal ball?
The broken
That's
one.
my crystal ball.
Okay.
Yeah.
Pretty good
Okay.
crystal ball. It's a pretty good one.
The
Yeah.
crystal ball's on Zoom. I saw it. It's on Zoom.
Yeah.
We
Okay,
have
guys,
another-
we're coming to the closeout. I've noticed the time's 2. Does anyone? Yeah, just throw it out there. Does anyone want to add anything? Just anything,
I
you know,
think
related or unrelated? Just as we sort of cap down here.
in deference to one of our participants here, they wanted to get a sense from Channing and Heather whether these trends that we've been talking about
Yeah.
are applying to the entertainment industry and to streaming as well.
Mm.
I don't know if either of you have any insight on that or any clients in that sector. I mean, my sense is that, yeah, there's a ton of activity happening in entertainment and streaming. I don't know. I mean, certainly there's a huge push for kind of a land grab on content. I don't know about traditional M&A per se. Jerome, I don't know if you have a sense for that.
Yeah, I think real quick is I think that there's the roll-up trend is happening in entertainment as well. And so certainly any kind of technology enabled companies related to entertainment, there's roll-ups happening. Certainly there's a huge appetite for content. So I think that, you know, that there's especially influencers, social media, you know, TikTok integration, film. I mean, so I think this applies to, I think, entertainment as well. I've seen at least one deal in that space that was a roll up. So I think it does apply.
Perfect. Thanks for that, Jerome. Anyone else want to add anything about the future besides Channing, because he already knows it? Heather, what do you want to?
I was just going to say,
send
plan
us some
ahead.
of your great energy. Send
Plan ahead.
Is that what keeps the smile going? Planning.
Yeah, right.
You know,
What?
I'm going to just say that I think we have cause to be optimistic in general, in my opinion. You know, I think we're rounding the corner here on COVID. I think certain fundamentals are pretty good. I think we have cause to be optimistic, in my opinion.
And coming from a seasoned professional lawyer such as yourself, Constantine, I feel better already.
My smile's bigger.
Huge. It's almost as big as Heather's. Guys, so on that note, I want to personally thank all of you, Constantine, Heather, Channing, Jerome, for putting this little panel together and for exploring the M&A renegade and what's happening in the market, what's going to happen in the market. And I thank you all for sharing your beautiful thoughts. And I hope that everyone who was watching had as great a time as all of us. Or I'll speak for myself and say as great a time as me, because I had a blast. So thank you all. Thank you all for joining us.
For having us.
Yeah, thank you, Heather. Wishing you all a great day in your virtual offices. And yeah, look forward to the next time or the next one.
Thanks,
you.
guys.
Thank you, Heather, Channing. Thank you guys so much for your time. Thank you, guys. Thank you, Mark.
Appreciate it. Thanks, Jerome.
See you later.
Bye,
Thanks,
guys.
everyone.